You make $78,000 a year. You miss one quarterly tax payment. The IRS sends a letter. Penalty. Interest. Maybe a fee. Meanwhile, a trillion-dollar tech company announces, due to updated tax provisions, our effective tax rate will decline. Translation: they legally owe less. You owe more for being late by $214. Here's what nobody says out loud. The tax system isn't just about rates. It's about structure. When you hear, corporate tax rate is 21%, it sounds simple. But that's like hearing, the car costs $40,000. Before rebates. Before incentives. Before credits. Before deductions. Big tech companies don't just pay taxes. They engineer them. They invest in tax attorneys, accountants, lobbyists, international subsidiaries. You invest in TurboTax. That's not an insult. It's scale. The law favors capital-heavy, R&D heavy, multinational businesses. And guess which companies fit that description? This isn't a political rant. It's not, corporations are evil. It's how the system works. And once you understand it, you stop being surprised. Here's what changed under recent U.S. tax provisions that benefits large tech firms. 1. R&D deductions. Tech companies spend billions on research and development. Those costs can reduce taxable income. Invest $10 billion in innovation. Taxable income shrinks. 2. Bonus depreciation. Build data centers. Buy servers. Invest in AI hardware. Instead of deducting those costs over 10 to 20 years, companies can accelerate large portions upfront. Lower taxable income this year. 3. International tax structuring. Multinationals can offset U.S. tax liability with foreign tax credits and global income rules. If you earn in one state, you pay there. If they earn in 47 countries, they optimize. All legal. All powerful. Let's simplify with clean numbers. Company earns $50 billion pre-tax. Headline corporate rate, 21%. You'd think, $50 billion times 21% equals $10.5 billion in taxes. But they deduct $12 billion R&D, a $5 billion accelerated depreciation, a $3 billion foreign tax credits. Taxable income becomes $30 billion. $30 billion times 21% equals $6.3 billion. Effective tax rate, 12.6%. Almost half the headline rate. Now compare that to an employee. You make $78,000. After the standard deduction, maybe $64,000 taxable. Marginal rate, 22%. You can't depreciate your laptop against W-2 income. You can't deduct career research. Different structure. Different game. Let's compare two people. Person 1, high salary employee, makes $200,000 in W-2 income. Limited deductions. Federal plus state plus payroll taxes can reach 30 to 40% combined. Every extra dollar is taxed immediately. Person 2, founder or large shareholder, owns equity. Company reinvests profits. Stock appreciates. No tax on appreciation until shares are sold. When they do sell, capital gains rates are typically lower than ordinary income rates. Plus they control timing. The employee trades time for taxed income. The owner accumulates assets that compound before taxation. That's the structural difference. Not intelligence. Not morality. Structure. So what do you do with this? You don't rage post. You adjust strategy. If the tax code favors capital, start building capital. A brokerage account. Equity compensation. A small business income. You don't need a billion-dollar company. You need exposure to asset growth. Income is taxed immediately. Assets are taxed when realized. That timing difference is massive. If you invest $500 per month and it grows to $500,000 over decades, that growth compounds before taxes are due. That's the same mechanic corporations use. Scale is different. Principle is identical. You can think the system is unfair and still play smart. Waiting for reform doesn't build wealth. Optimizing within the rules does. Big companies design tax efficiency into their structure from day one. Most individuals think about taxes after they earn money. Design beats reaction. The tax code rewards investment, risk, capital, infrastructure, ownership. It penalizes A pure earned income. Simplicity. A being small. That's not emotional. It's structural. So the real question isn't, why do they pay less? It's, how do I shift from taxed labor to compounding assets? Once you understand the game, you stop playing the wrong one, and you start building leverage instead.